Hi there, welcome to the channel. So today I want to look at what happens to the stock market when the Federal Reserve raises interest rates. So to do that, I'm going to look at a long-term chart. I'm going to start here. Now, what I have here is I have the S&P 500 are the candlesticks, okay? So you can see this should look familiar to anyone familiar with the market. This goes all the way back to 1980. You see we had a high here, low, high, low, and we are off to the moon here right now, currently. Note also that I'm doing it on a monthly basis. I'm just kind of smoothing this out a little bit, okay? Okay, then this black line here, this is the Fed funds rate. So this is the rate that's controlled by the Fed. There could be details, there can be variation from what they set, they have a target, et cetera. But pretty much when you put this up against things like the short-term interest rate, like the 3-month bill, they generally match really close. So it is a good proxy, and it is the rate that the Fed is setting. Then in this lime green, what I have here is the 10-year. So what I want to do is I'm just kind of trying to look at what happens to the stock market when the Fed is on an interest rate hiking cycle, and then also kind of compare what happens to the Fed funds rate that they're changing and what happens to the 10-year during that time. So just including this all the way over here in the 80s, this is like, very high interest rates. Fed funds rate was, very volatile all over the place. And this is because this was the period of time, where Volcker was, trying to kill inflation and stuff. So that's what was going on there. So I don't know how useful that's going to be. I'm not trying to cherry pick data. I'm just trying to look at a few things. Then we have over here in the 90s, the Fed had kept dropping rates here, and we see the market just kind of continuing to kind of go up, and the market's on the right side axis here, and interest rate is on the left side. But then they go through an interest raising cycle right here. So let's try to see what happens there. So from 94 to 95, they're an interest rate cycle. Okay, yeah, so 94 to 95. So you can see here that over here, they're raising the interest rate. The Fed funds rate is going from about 3% all the way to 6%. So they double it in this period of time. Now they double it from beginning in 94 to, so it took them about a year to do that approximately. And what's interesting here is it doesn't look like initially the yield curve didn't appear to invert, at least on the 10-year. And then all of a sudden what happens is interesting. The 10-year kind of goes bloop, and the yield curve is inverted. So anytime the 10-year interest or yield is less than the Fed funds rate, you have an inverted yield curve. So right here, you've inverted the yield curve, and it inverted a lot over here. Over here, the inversion is like from a comparison of something like 5% to 3.6%. So that's a very significant inversion. But what's happening this time is the market's just going up. So 95, 96, 97, 98. It's just really, in the big picture on the monthly, it's just cranking to the moon. That's what it's doing. And the first hiccup we get is over here in 98. Now, what's really interesting here is throughout this thing in 98, it looks like they responded, and they dropped their Fed funds rate from about 5.6%. They dropped it down to like 4.6%. So they dropped it a percent in response to that. And then the market just kind of took off and kept going. So that's kind of what happened in the 90s into 2000. Then we have this peak in the stock market here in 2000, and they had raised rates even some more. So that kind of have a continuation of the raising cycle, and they get the rates up to 6%, and then kapooey, things break. Now the stock market over here was at 1550, and it ended up going over the next 2 years or so all the way down to 850. So 50% drop approximately. Just call it a 50% drop. So that was a significant drop. And, one of the things is this could very well have been because the Fed raising rates, maybe they raised it to the point that, hey, 6%, everything just broke. So I remember that in 2000, that's what it looks like happened here. So in this case, this is interesting. So let's try to keep some things in mind. They raised interest rates, they broke something. The stock market, as in the S&P, went down, call it 50% over the next couple of years. Now, NASDAQ went down much more than that. But the thing is, they had already done a raising cycle back here in 94, 95, and it did nothing to the market. The market just kept going up. I mean, it didn't hurt the market at all, apparently. Matter of fact, they started over here, or 94 raising, and 95, they're significantly higher. And in 95, when they're higher, it started cranking up. Now, maybe what's really going on is the market here was happy with the fact that they seemed to lay off the rate. They seemed to stop raising the rates. They kept them high, and they even then lowered them a little bit in here. But so maybe that's what it is. I mean, the market may not like the change in rates, the rising rates, but they might be okay with it being high. But in the big picture, this whole period of time, the market just running until we have this problem in 98, where once again, something broke, they responded. So kind of, that's kind of keeping that in mind. So if the Fed's going to go now and they're going to raise rates, what's going to happen? Does it mean that the market's going to go down? Maybe not. If in effect it ends up being something like we saw over here in the early 90s, then it would have no effect. It would be like buy the market, right? That's kind of what that's telling you there. Now over here, this rate rising cycle over here. So this rate rising cycle right here. So this one over here, that's kind of a different story. When they raise the rates here, boom, something broke, and then the market really did take a decent tumble. So it would be more skeptical of the market. And what's interesting, so you have two different indicators here, right? Two different indicators looking at what happened in the cycle in the early 90s to the late 90s into 2000. Now, what's interesting here, they really dropped this rate to almost zero. Yeah, it is at zero. So in 04, they actually go down to, 1%, pardon me, it is 1%. So they didn't go to zero yet, 1%. And they start another rate rising cycle. So let's clear all this. What happened during the next rate rising cycle here? Okay, so now we're going to this next hump. Okay, so now what's going on here? 2000, we had the implosion, rates come down. They're down here at like 1%. They really got them pretty low. And then they start raising them again. So in 04, they start cranking up the rates. Now, it's really interesting. It's sort of just like a steady, continuous increasing in rates. This is not like a natural thing. This is, the Fed deliberately were increasing rates, we're forcing rates up. So it's an artificial rate. It's what they're trying to do. Now they have, if you look at the Fed funds rate and you look at the short-term rates and you track those charts, I mean, they track pretty well. And so you can see that they have a lot of control over the short-term rates, but they don't have much over the long. If you look at the lime line here, sure, it's all over, but it's not going up. It's not tracking it. And then, so what happens now? Here we go, 05, the Fed funds rate keeps going up. They keep pushing up. The 10 year is not responding. So the 10 year is saying, hey, we're at 3%. Fed funds goes all the way to 5%. Now, here we go again. Then they stop up here. So they stop. So now, I want that line. Yeah, that's good. Yeah, so they stopped raising rates, but they've already gone too far and they broke it. And what's interesting here, so now this is another case where you have, this is the inversion of the yield curve because the yield on the 10 year is lower. So if you're lending money for 5 minutes, you get 5%. If you're lending money for 10 years, you get 3%. So that's inversion, which is something's wrong. So obviously, like they start going here, they start lowering it. And I assume it's in conjunction with things breaking in the financial crisis in 08. And boom, broke. And then here we're going from 15 to, it's really the same thing. Call it, it's approximately 50% loss. So now we have just 2 cases of rate cycles. Now, this is maybe a separate cycle from this one, could be, but just anecdotally, it looks like, hey, 2 times the Fed raised rates a lot and they broke things. And it took the market went 50% correction. The previous time, before that, the Fed basically raised interest rates a similar amount, potentially, and it helped the market, which is really weird. So now let's go forward to the next one. So now 09 financial crisis, what is going on? We're down to 0 now. So let's go here. Okay, so now we're down at 0 here. Let's do that. Okay, so now we're down at 0. And so we're here. And now they've just put rates at 0. The 10 year is up here. Things are normal. It's really interesting right here in 012. The 10 year goes down really low, a really flat yield curve. But now the market's just running. I mean, it's just running. So let's clear all drawings. Let's try to get to where we are today then. So now we're in this situation. They have left rates at 0 for this huge period of time, and then they cranked rates again. Now, this is going to be really interesting. So let's try to figure this out. So let's bring this little forward like this, and let's try to figure this out together here. So they kept rates at 0 for 5 years, 6 years, incredible. And the market, going up. But now we get these little hiccups. There is a hiccup here that we got. Now this wasn't pervasive. This was just a hiccup because they were raising rates. They went from 0 to 2.4%. Also notice that every time like the rates are overall going down when they go through a cycle, they never get it above where it was before. So there's something structural, 100-year structural thing going on. But here they raise the rates, and in this case, the market starts hiccuping, but it was very short term. But then they kind of respond and start cutting rates. And then, of course, we get the pervasive thing where this was significant. This is like 30% drop in there, very significant drop. And they just brought rates to 0 again where they are, and they've left them there ever since. And now they're talking about raising rates again. So, okay, so the big picture, what's going to happen here? They're going to go dot plots, things like that are looking for maybe 3 rate hikes. First of all, getting quantitative easing to approximately 0, maybe in March, and then immediately after that, 3 rate hikes. So you can see 3 rate hikes. I would assume quarter point, so that would put them at 0.75%. So in reality, that's like going from here to, it's a move about this much, something like that. So it's a very small move in the rates. So the question is, what effect is this going to have on the market? I mean, it's really hard to say. We saw 2 places where the Fed rate raising cycle. So let's try to summarize. We saw 2 places where the Fed raised rates and broke something, and the market came off in the 40-50% range. We see in other cases where they raise rates and something starts to break and it kind of resolves, or when they stop raising rates. And then we have other cases where the market breaks and things and the Fed just responds going to 0. So there definitely was cases where the Fed raising interest rates caused the stock market to go down. But see, the issue, what's going to happen if they raise it like so? At worst, you would think they would raise it 1%. Now, here's the unknown. The unknown is all this other time we didn't have the quantitative easing, right? So we didn't have quantitative easing for these other rate cycles. Well, we did have some for here. I believe we had some in here, but we didn't have as much. Now we are at something like 80. I was seeing like 80 billion a month. And apparently it's more than that, 80 billion bond buying a month. There's supposed to be 130. And so that's kind of an interesting thing to factor in. As I said in my other video, I suspect that, every $10 billion of quantitative easing is equivalent. It's probably equivalent to, 0.1% rate hike, something like that. I mean, I don't know. We don't know what it is. That's the point that I'm getting at. We don't know, right? So if we look at it and say, hey, they're going to raise rates 1% in all of 2022, then you look at that and you say, hey, they raised it 3% here, 6% here, 5% here, and then something broke. I don't think you can find a spot here where they raised it 1% and caused any problems. So you would say, you'd bet on the market. You'd bet that everything's going to be fine. But what's different is when you go compare with all those times, you did not have this kind of quantitative easing. And so that's the wild card in the situation. I think that, so it's not very clear. It's really not very clear what's going to happen. But I think, it's something to kind of keep in mind. If you're out there and you're investing and you're trading and people are going to sell you that, oh, the Fed's going to raise rates and it's going to be the end of the world, it could be. And then you have other people selling you that, oh, the Fed's raising rates and it's going to be no problem. Well, it could be, right? But we don't know what happens when you shut off, 80 billion, 120 billion of bond buying. Like, we don't know, like, what effect that has. And then the ripples, and that's where the unknown is. That's where we're at. We'll see what happens. All right, that's it for this one. Talk to you later. Bye.